This is a presentation of Chapter 14, the Statement of Cash Flows. In the first learning objective, we're going to talk about what are the purposes and the uses for the Statement of Cash Flows, and then just in general talk about what would be included in the operating, investing, and financing cash flows in the Statement of Cash Flows. So first of all, what is the Statement of Cash Flows? You may remember the Statement of Cash Flows from Principles 1. We did talk about it a little bit in that course, but in this course, we're going to go into much more detail on it. So what the Statement of Cash Flows reports on is the business's cash receipts and cash payments that they have made within a specific period. So it'll be the cash flows from the business, where the cash came from and how they spent it, as well as why did cash on the balance sheet increase or decrease during the period. This statement, just like the income statement, is going to cover a period of time. So the heading of it will have something like year ended December 31st, 2024. Now, the purpose of the Statement of Cash Flows is to explain why the net income that is reported on the income statement doesn't equal the change in the cash balance on the balance sheet from the beginning to the end of the period. So, in other words, the Statement of Cash Flows is really kind of a link between the accrual-based income statement and the cash that's reported on the balance sheet. So why do we want to have a Statement of Cash Flows? Well, first of all, investors and creditors are interested in being able to predict the future cash flows for the business. That's always very important. And past cash receipts and payments are probably one of the best predictors of what the company will be doing in the future. Also, the Statement of Cash Flows provides information that's not provided in the other statements that can help these investors to evaluate whether or not the managers of the company have made wise investment decisions, because it gives them information on investing and financing cash flows. So as we said before, lenders want to know whether the company is going to be able to pay the interest and the principal on the loans. And then stockholders also want to know whether or not they can expect to receive dividends in the future. And both of these depend on the cash flows for the business, and that is why the Statement of Cash Flows is so important. Now, there are three basic types of cash flows, and the Statement of Cash Flows has a separate section for each one of these, and we're going to talk about these in future slides. But for right now, just know that there are three different types of activities or classification of cash flows in the statement. There are operating activities, investing, and financing. All of these are going to give the readers information on the cash receipts coming into the company and the cash flows, or the cash going out of the company. So first of all, let's talk about the operating activities. They are shown first on the Statement of Cash Flows. So what this section is going to do is it's going to report on the activities of the business that create the revenue or the expense for that business. So it reflects the day-to-day operations of the business, such as cash receipts or cash inflows from customers for the sales of merchandise, inventory, or services, and then the cash outflows for purchases of merchandise, inventory, or just the everyday payment of the operating expenses. So the operating activities section is also going to include information on cash inflows for interest and dividend income, and cash payments for interest expense and income tax expense. The second section of the statement of cash flows is called the investing activities. And this section is going to report on cash receipts and cash payments that increase or decrease the long-term assets, such as property, plant, and equipment, notes receivable, or the investments, if the company has any. And it's going to include the cash inflow when they sell any of those assets, and the cash outflow when they purchase any of their long-term assets. It's also going to include information when the business, if they do loan money, and then when they collect money on any long-term notes receivable. The last section, or the third section of the statement of cash flows, is called the financing activities. And this is going to include the cash inflows and outflows that are involved in long-term liabilities and equity. So it's going to include things like when the company issues stock, pays dividends, or buys and sells treasury stock. But it's also going to include information when they borrow money and when they pay off long-term liabilities such as notes payable, bonds payable, and mortgages payable. So to summarize the information for the statement of cash flows and where we get that information from, this diagram shows us that we get the information from the current assets and current liabilities to complete the operating cash flow section. We get information from long-term assets to complete the investing cash flow section, and we get information from the long-term liabilities and equity section to complete the financing cash flows. Now, there are some activities that businesses do to invest that don't actually involve cash. These types of transactions are actually called non-cash investing and financing activities. So these activities are not going to appear in the three sections of the statement of cash flows. But because they are important, they're either going to be shown as a separate schedule at the bottom of the statement of cash flows, or they can be included in the notes to the financial statements. So what type of activities would we be talking about that would be included as non-cash investing and financing activities? Well, for instance, let's say that we purchase some long-term property, plant, and equipment, and we finance that with a long-term note payable. There wouldn't be any cash involved in that. There would be the equipment and the issuance of the note, but no cash would have changed hands. Also, sometimes stockholders may contribute assets to the business in exchange for common stock. So again, there has been no cash involved. Now, these are still important activities, so again, we would either include them in that separate schedule or in the notes to the financial statements. Let's look at the sections of the statement of cash flows again, just to make sure that we understand what are included as cash inflows and outflows in each of the sections. So within the operating activities section, we're going to be looking at cash inflows from our customers, either if we sell them merchandise inventory or if we perform services. But we're also going to see cash inflows for any interest revenue or dividend income that we receive from our investments. In the cash outflows, we're going to see cash outflows for purchases of merchandise inventory, but also for payment of the day-to-day operating expenses for the company. Those are usually going to be reflected in the current liabilities. We'll also show any payments that we make for interest expense and for income tax expense. Now, for our investing activities, our cash inflows are going to be when we sell property, plant, and equipment, or when we make sell one of our investments. But we'll also see cash inflows when we collect on any long-term notes receivable. Our cash outflows in our investing activities are going to occur when we purchase property, plant, and equipment, or when we make a long-term investment, or when we loan money to borrowers. In the financing activities section, we're going to see cash inflows when we issue stock or when we sell treasury stock, but also when we receive the proceeds when we borrow money. We're going to see cash outflows when we pay dividends to our own shareholders, or when we buy treasury stock, or when we repay our long-term liabilities. And then again, as we mentioned before, there will be a separate schedule, usually at the bottom of the statement of cash flows, that's going to show us those investing and financing activities that did not include cash. There are two different formats for the operating activities section. There is the indirect method that starts with accrual-based net income from the income statement, and we make adjustments to net cash provided by operating activities. And we're going to use accounts in current assets and current liabilities to determine the changes in cash. There is also the direct method, and that is where we kind of take the income statement and we completely restate it to a cash basis. That is actually going to show the actual cash receipts and cash payments. The FASB prefers the direct method, but it allows the indirect method, and most companies use the indirect method. As you can see from the slide, IFRS allows either the use of either of the two methods. Now, on the statement of cash flows, the only section that will be different is the operating activities section. The investing and the financing activities sections will be the same for both, for all of the cash flow statements. Another thing to remember is whether you use the indirect method or the direct method, you're still going to produce the same amount of net cash flow from operating activities. And that is the conclusion of the presentation for Learning Objective 1.